What's up everybody, Huddy coming back to you. Today we're talking about student loans, specifically if they're in default, and also how does a mortgage company calculate your student loan payments when it comes to getting a mortgage. So let's start with the defaulted ones. In this country, at one point, I believe 1 in every 3 student loans were in some sort of default status. That's a huge number when you consider the amount of students that are out there. We've all heard about the student loan bubble bursting and when that might actually happen. So let's get to it and talk about how we get those student loans out of default. You have a few options when you're trying to attempt this. The first thing I tell people is give yourself time when you want to call your student loan servicer. Doesn't matter if it's Fed student loan, Great Lakes, Navient, it doesn't matter. Give yourself time to talk with them and be patient. They're also going to be wanting to talk about your financial situation. So kind of have an idea of what your budget is, what your rent is, what your expenses are, or your mortgage payment. Whatever that is, know ahead of time what that information is, because you want to talk to them about a couple of things. The first thing that you might want to look into is getting into a hardship deferment. What they're looking at is what is your current financial situation, and do you have any capability of making any type of payment whatsoever to them. If you're a newer student to someone who's been out for a while, life happens and they do understand that. So you might be able to get a little bit of a breather for 6 months to a year getting into a hardship deferment status, which really helps your credit because it pulls it out of collections and stops a lot of those late fees, and it also stops negative and derogatory reporting on your credit, which is what we're after. The next thing you can look at doing, if that doesn't work, is you can look at a loan rehabilitation program. Basically, they're going to look at your financials, see what your balance is on your student loans, and figure out a monthly payment that you can afford. I've seen them as low as $5 a month, and when you do that, they're going to have you complete that over 9 months. After 9 months, they're going to send you out to a new servicer where you can start over. Again, what's going to happen there is they're stopping the negative and derogatory reporting. You're getting those student loans back on track. Then when they kick back out to a new servicer, it's a fresh start. And from there, you might be getting onto an income-based repayment. Maybe from there, you can get into a hardship deferment status. Who knows? But you have new options. The other thing with that rehabilitation program that people don't often know about is if you're trying to get a mortgage and you're on some sort of cavers list, it's called, and you can't get that. Well, once you've been in that rehabilitation program and you've completed 3 months of on-time payments, you're typically allowed to consolidate your student loans right then and there so that it can reset you with that new servicer before that 9 months is up. So it can kind of leapfrog you ahead a little bit quicker. Speaking of all those payments and what all that looks like, let's talk about what that looks like in a mortgage. So there's really 2 types that we're looking at, the conventional loan and the FHA loan. In the FHA world, if your student loans are in a deferment status or an income-based repayment, as of right now, we're going to use 1% of the loan balance versus what the reported payment is. FHA is always going to take the higher of the 2 to calculate debt to income. So if you owe $20,000 but your payment is $100, we're going to factor, because it's income based, we're going to factor a $200 a month payment. So that's going to really hit that debt to income. In the conventional world though, we're going to look at what your student loan payment actually is, meaning what is being reported to the credit report. So if you're in a monthly payment plan or income based and it shows, and you have a letter showing it's like $20 a month and that's what reports to the credit bureaus, that's what we're going to use, and that's how we're going to calculate debt to income. There's a lot of different ways that this gets looked at, and a lot of it can be confusing. So if you like what you heard, click my face, subscribe to my channel. If you have questions specifically, you can comment right below and I'll answer them for you. Thanks for checking me out.